Best morning, teachers!
And hello to everyone.
As we face one of the darkest times, our lives and our country's economy have been disrupted. Our way of living has been changed.
But as a person who thinks as an entrepreneur in our current situation that we have now, this will be a new dawn for an opportunity to save the economy of our country.
As we believe of what Lori Grainer said,
entrepreneurship is the way we take control of our lives in a tough economy.
I am Renato B. Torio Jr.
I am Christine Joy D. Silvania.
We are going to discuss to you the financing business ventures.
Stay tuned, sit back, and relax.
You're selfish. You're selfish.
So let's now start. The success of a business depends on the effective use of financial and non-financial resources. It is the manager's responsibility for determining financial needs for business and to ensure the right borrowing and financing decision. So, in business, we have to determine what are the financial needs of our business. We need to analyze the requirements of funds, financial conditions and profitability of the business, involvement of the business risk, and ask yourself, is there any deficit of funds? Yes or no? If yes, take financing decisions. Before taking any financing decision for business, first of all, it is required to analyze some factors, and on the basis of this, it is possible to identify whether there is a deficit or surplus of funds. If there is a deficit of funds, then it is required to take financing decisions. What is deficit anyway? In financial terms, a deficit occurs when expenses exceed revenues, imports exceed exports, or liabilities exceed assets. A deficit is synonymous with a shortfall or loss and is the opposite of a surplus. First, the requirements of funds. It is required to check how much fund is required for the business over a period of time. This can be estimated through forecasting or trend analysis. Remember, the requirements of fund depend upon the type of business, collection policy of accounts and receivables, and business operations. The second one is identifying the profitability of the business. After analyzing the requirement of funds, the financial condition of business for a particular date should be measured, where the asset and liability position can be seen. In addition to this, the profitability of the business also required to be checked. If the profitability is high, then there will be more funds to spend, and the owner of the business will eager to spend more as he is getting more profit. The third one is risk involved with business. Here we consider the business risk, which arises when a business is unable to generate sufficient revenue by using its resources to compensate its operating expenditures. If a business risk is high, then it is needed to acquire funds through financing. A financial manager must consider all these three together to determine whether he or she will finance funds for the business or not. According to the nature of the requirement, the financing can be short-term or long-term. It is obvious to finance short-term requirements from short-term sources and long-term from a long-term source of funds. So let's now proceed to the 9 sources of capital. The first one is we have the savings, the credit cards, friends and family, SBA microloan program, action, angel investors, business loans and lines of credit, factoring, and purchase order funding. Number 1. Savings. Easiest way to finance a business is to use your own money. In an ideal world, you should save money for a period of time and use this money to fund your business. Some entrepreneurs take this step further and take money out of their homes through a home equity line of credit, their retirement plans or insurance policies, and use of those funds to run their business. This is very risky strategy because if the business fails, you stand to lose your house, retirement, and your insurance. And given that many small business fail in the first 5 years, the odds are stacked against you. Saving to start or operate a business is a great idea. However, we are against using retirement savings, home loans, insurance loans, and similar resources to finance risky business ventures. You should consider speaking to a qualified financial advisor if you plan to do so. The second one is credit cards. It can provide an effective way to finance a business and to extend your cash flow. You can use them to pay suppliers and often earn discounts, certain protections, or other rewards. The downside of credit card is that they are tied directly to your credit score. Cash advances are another source of funds. Most credit card companies impose on their cash advances and charge high rates for them. As such, using cash advances can be expensive, but they also be useful as a last resort. Credit cards can be very helpful in extending your working capital and alleviating cash flow problems, especially if you use them to pay suppliers. Be careful not to overextend yourself and remember that your credit score is affected by how you use your credit card. The third one, friends and family. Many entrepreneurs fund their small business by getting friends and family to invest in them. You can ask your friends and family to make an equity investment, in effect selling them a part of your company, or you can ask them for a business loan. Take note, asking friends and family to make an equity investment can be a good way to finance your company if you are very careful. Be sure to get the agreement in writing and have a lawyer draft it for you. Also, you should spend a lot of time educating your investors about the risk of your business. Lastly, you should consider reminding them to only invest money that they can afford to lose. The fourth one is the SBA microloan. The SBA has a little known but extremely helpful microloan program that provide business loans for up to $50,000 to small business. They don't provide loans directly. Instead, they use intermediaries to fund the loans. Many of these intermediaries also provide management assistance and may require training as a condition for a loan. Remember, this is a great program of the ASBA aimed at entrepreneurs who need money to start and operate businesses. The technical assistance they provide makes this program a great alternative for small business owners. The number 5 sources of capital is Action. It is one of the largest microfinance and small business lending networks in the United States and has offices in every state. In a sense, they are similar to an SBA microloan. They provide startup financing and they also fund ongoing concerns. To qualify for a general financing, you need to have been in a business for 6 months and you must have sufficient cash flow to repay the debt, among other requirements. Action also offers startup loans of up to $10,000. Our take on this: Action is a great source of funding for small companies, especially those that have strong local roots within their communities. Next is angel investors. Angel investors are private individuals or small group of executives who invest in business, usually by making an equity purchase. They can provide money, expertise, and guidance to help start and grow a business. Getting an angel investment can be very difficult because the investors needs to see growth potential and viable business plan with reasonable exit energy. These angel investors can be a good option if you find an angel who can provide industry experience and contact along with funding. It is very important that you retain a specialized attorney and possibly a CPA to help you understand how to structure the equity sale. Otherwise, you could end up with a substantially diluted ownership stake at subsequent fundings. You can find angel investors at the Angel Capital Association. The number 7 sources of capital is the business loans and lines of credit. These are well-known products in which a bank provides financing to run your business. In a loan, the bank gives you a set amount of money that is repaid over a period of years. A line of credit provides a revolving facility that can be used when needed and paid back on a regular basis, much like a credit card. Take note, loans and line of credit are a great way to finance a business. Lines of credits are particularly helpful to handle cash flow shortages. However, getting this type of financing is difficult and seldom an option for small companies with limited experiences. The second to the last sources of capital is factoring. This type of financing has been gaining popularity in recent years and is now commonplace. Factoring can provide a reliable sources of funding if your company has cash flow problems because clients pay their invoices slowly. However, you can only use factoring if you work with commercial and government clients with good credits. Take note, this can be a great option for companies with high gross margins and whose only problem is a lack of cash flow because of slow paying clients. Getting factoring is comparatively easy and the line is usually very flexible. The last sources of capital is purchase order funding. Like receivable factoring, purchase order funding is a specialized form of funding that has been gaining popularity in recent years. It's designed to help companies that resell goods, at a markup and need funds to pay their suppliers. The finance company pays your supplier directly, which allows you to fulfill large order. Remember, this type of funding only works if the transaction is for the resale of finished goods and if gross profit margins are 30% or higher. However, if your transaction qualifies, it is a great tool to handle large transactions without giving up equity, like factoring. Qualifying for funding is relatively simple. So those are determining financing needs for business and the 9 sources of capital. Let's now welcome Ma'am Christine to discuss to us also some parts on how to finance business ventures.
Thank you, Sir Ren. So now let's proceed to letter C, which is the rules of sound financing. So what is sound financial? Sound financial management is the careful tracking and prudent management of your company's financial resources and cash flow. Without sound financial management, information can be wrong or absent, decision making is flawed, and minor issues can become serious problems that put the business itself at risk. It means sound financial management is really important for an entrepreneur so that his or her business will have a nice flow and will be successful. Next is sound finance rule. Sound finance involves a set of rules. First, always balance the budget except in warm time. Cash flow is what matters. So, in handling money, you should be wise. What's on the budget list should be the priority. Next is, do not increase the money supply at a rate greater than the growth rate of the economy. Money has time value. That is why sometimes increasing money supply makes your business close, or doing this may become serious problem that makes your business at risk. Now let's proceed to C's of credit. So by the way, what is credit? Credit is the ability of a customer or a client to obtain goods or services or even money before payment. Most leaders incorporate the C's of credit to understand how likely you are to repay your debt. These are the 5 C's of credit: character, capacity, collateral, capital, and conditions. The first is capacity, your financial ability to pay the lender back. Show your lender that your client can afford the payments on top of their living expenses and credit obligations. A true understanding of a client's income is important here. So you must know on how your client can pay her debt, what is her work, or if she is capable of lending money. Next is character. Credit behavior based on indicators like your credit report, score, and payment history. Stability is important. Show your lender that your clients are willing to pay the loan. Be sure to complete the application accurately, as this information will lead your underwriter in assessing the client's character. So you must know the status of your client, whether she is single, married, or divorced. Make sure also that all the information given by the client are true. Better know his characteristic and attitude, because the borrower's reputation or track record for paying debts. This information appears in the borrower's credit reports. And try to complete the application fully and accurately, as all the information on the application ultimately leads the lender through an assessment on character. The third one is collateral. An assess, you pledge to the bank loan. This is all about the subject property, type, location, and marketability. It is important to the lender to understand where they can recoup if a loss were to occur. Collateral is an asset that a lender accepts as security for a loan. The collateral acts as a form of protection for the lender. That is, if the borrower defaults on their loan payments, the lender can seize the collateral, sell it to recoup some or all of its losses. It includes savings accounts, debt, credit cards, and even properties like house and lot, business establishments, and even farms. For the fourth one, conditions. Market analysis of the trends of your industry. The conditions of the loan, such as its interest rate and the amount of principal, influence the lender's desire to finance the borrower. Conditions can refer to how a borrower intends to use the money. Consider a borrower who applies for a car loan or a home improvement loan. A lender may be more likely to approve those loans because of their specific purpose rather than a signature loan, which could be used for anything. In addition to that, lenders may consider conditions that are outside of the borrower's control, such as the state of the economy, industry trends, or pending legislative changes. The last C of credit is capital. Your own money you are investing in your business, often a down payment. Net worth equals asset minus liability. That is the capital. What is your client doing with their money that is tangible? What is their down payment and where is it coming from? Your lender wants to know that if a significant life event were to occur, can your client meet their financial obligations? What is the down payment amount and where it is coming from? What is your client's net worth? What assets does your client have? So those are the questions that you should consider in capital. This information will help your underwriter make sense of what your client spends in their income on. Lenders also consider any capital the borrower puts towards a potential investment. A large contribution by the borrower decreases the chance of default. So those are the 5 C's of credit. Now let's proceed to managing your financial resources. There is no time like the present when it comes to learning how to manage money better. There is never a bad time to make a financial fresh start. It makes sense to rethink how you're managing your money at the start of a new year. It's a really good time to start a budget because all your big numbers are coming in, says John Brodsky, US CEO of Finder. However, creating a budget is only one part of how to manage money better. And if you start there, you'll miss few critical steps. These include mapping out your current finances and prioritizing your spending needs. Here are 7 steps to take to manage your money properly. The first one is understand your current financial situation. Before you can start managing your own money better, you need to know how much of it you have. The most basic step to understanding your current financial situation is to sit down and record all your regular monthly income and expenses. If indeed, save receipts for a month to determine where money is spent beyond major bills like rent, utilities, and debt payments. Understanding your current financial situation makes your business flow naturally, and recording your income and expenses will make your business in a good flow. For the second one, which is set personal priorities and finance goals. Once you have laid out your current financial situation, it's time to determine whether it aligns with your values. I think it's all about having goals, says Timothy Mark Groth, a certified financial planner and managing partner with Riverpoint Wealth Management in Chicago. Defining what you would like to achieve with your money can make the process of creating a viable budget much easier. For instance, if spending weekends with your family is a priority, paying for a housekeeping service may free up valuable time and be a smart use of money. However, it may not make as much sense if travel is a bigger priority. In that case, the money spent for housekeeping may be better spent on vacations. For the third one, create and stick to a budget. Writing a budget designating how your income will be spent each month isn't necessarily hard for many people. Following it, though, can be a challenge. That right there is the hardest part, Beryl says. People may not have the self-discipline to limit impulse purchases, or they may feel too restricted by having to plan their spending in advance. Budgeting helps us to decide on how we will spend the money. However, the reward for sticking to a budget is having cash available to spend on those items most important to you. What's more, it will be easier to follow a budget that is written with your priorities and goals in mind. If you discover there isn't enough money to pay for everything you'd like, look for ways to whittle down expenses. While eliminating small, recurring purchases such as duplicative streaming services or takeout coffee is often suggested. Brodsky encourages people to think big. Next, establish an emergency fund. Part of how to manage money better is to have cash set aside for unexpected events such as lost job, illness, or broken car. As Matt Groth says, everyone needs an emergency pot for 3 to 6 months of expenses. So the best way to create this fund is to include savings in your budget. How much you can save can depend on how much extra money you can have available. And it is also recommended that you should put aside at least 10% of your income into emergency savings fund each month so that you will have money in case of emergency. For the fifth one, save for retirement. At some point, you may want to retire, and that will be hard to do without a retirement fund. Social Security benefits only replace approximately 40% of your income, and many employers no longer offers pensions. Regardless of which retirement account is used, don't make the mistake of selecting investments based on emotions. Don't let fear and greed dictate your investment decisions, Curry says. Speak to a financial professional if you need to help creating an investment strategy that matches your needs and goals. Workplace retirement plans can be a good place to save for retirement since contributions are automatically deducted from payroll. Plus, many employers will match a portion of their workers' contributions, further boosting retirement savings. There are tax incentives for these accounts as well. For the next one, pay off debt. Having a debt can get in the way of meeting financial goals. I don't want my clients to carry any debt except a mortgage, Mark Groth says. Since most debt accrues interest, Becoming debt-free can be a long process if you are only making minimum payments. In some cases, it may help to consolidate high-interest credit cards into a lower-interest loan or line of credit. You are going to pay it off quicker and you're going to pay less till saves. So, however, debt consolidation only works if you commit to living within your means going forward. Otherwise, you could end up with both a debt consolidation loan and a new credit card balance. If you do get a loan, choose one with the shortest term possible. And for the last one, schedule regular progress reports. Managing your money successfully is an ongoing process. A lot of times, clients think they are doing a good job, but how do you judge? McGrath says. It helps to schedule regular times throughout the year to evaluate your financial situations. McGrath says, people should always know their income, savings, spending, and net worth. Beyond those four numbers, use these check-ins to determine what progress has been made toward financial goals and whether any budget items need to be adjusted for the future. So, scheduling is very important because it makes your work organized and have a better progress.
Thank you so much, Ma'am Tin.
Always welcome, Sir Ren.
We hope that you've liked our simple presentation.
And I believe that you've gained knowledge and insights on how to finance your business.
Of course, Ma'am Tin. We are now ready to build our own business soon. Thank you so much, everyone.
Once again, I am Christine Joy D. Silvania,
And I am Renato B. Torrio Jr.
saying,
never give up. Today is hard. Tomorrow will be worse. But the day after tomorrow will be sunshine. Goodbye!